certainly the speed of the turnaround in equity markets did take me and a range of people by surprise.
To say that it's been a dramatic 12 months would probably be a bit of an understatement.
Despite all of that, the returns from superannuation have actually been very, very strong. And in particular, the returns from share markets have been very strong.
Hi and welcome to Super Insider, the podcast where we focus on superannuation, retirement, and especially today on investments. My name is Josh Van Gestel, the Senior Manager of Education here at Australian Retirement Trust. And to help me in this episode, I'm joined by Brian Parker. Hi, Brian. How are you?
Hello, Josh. Good to be here.
It's good to have you, especially at the start of a new financial year. It's important that Brian and I reflect back on the last 12 months and, in fact, a bit further than that. But before we do that, I'd just like to start by reminding you that everything Brian and I cover off today is of a general advice nature only. So we encourage you, after listening or watching this podcast, that you actually look at our website or get in touch to have a much deeper conversation or to find out some further information. Now, Brian, to say that it's been a dramatic 12 months would probably be a bit of an understatement, wouldn't it?
Yeah, very much so. If I think back to the start of this financial year just gone, we started the financial year worrying about trade and tariffs and the like. Then we had airstrikes against Iran by Israel and the United States. Then we started this calendar year with US strikes against Venezuela and President Maduro being basically taken to face trial in New York City. And that caused a bit of turmoil in oil markets for a little while as well. But the big news really more recently is obviously the outbreak of war with Iran, which obviously caused a lot of grief in financial markets and the world more generally.
If we just catch up, maybe the last time we came together and spoke was about 3 or 4 months ago. So let's start going backwards, but firstly focus on that last 3 months. What have you seen happening around the economy as we've seen the war carry on much longer than was expected or was being stated? What have you seen markets do as a reaction over the last few months?
Well, last time we spoke, we deliberately designed the conversation to be reassuring. We deliberately designed the conversation to explain to members that over the course of any long-term investment journey, that crises are going to happen, that market downturns are going to happen, and yes, wars are going to happen. But every crisis and every setback, if you will, they all have one thing in common, that is they come to an end. Now, for this particular one, we certainly didn't expect things to come to an end as quickly as they did, at least in a financial market sense. So we did see share markets fall very, very sharply and unsurprisingly in the immediate weeks after the start of war. But things turned around very, very quickly. Because I think markets took the view, and you certainly saw this in the oil market as well, that even though you saw share prices fall sharply, oil prices spike up sharply, markets were basically factoring in the idea that at the end of the day, common sense would prevail. You wouldn't necessarily see an ideal outcome, but you would see all sides to the conflict take some sort of an exit strategy or some sort of an off-ramp, to use the phrase. That's the way things have panned out. It's still a very, very uncertain environment, obviously. There's still going to be periodic tension. It's still going to erupt into a shooting match at various stages, but things have settled down, and it seems as though neither side to this conflict really wants to escalate this any further.
And the other thing you've talked about to me separately is that it's also shown resilience in the market over the last 12 months.
I think it's also the certainly one of the things that's been I suppose a pleasant surprise, if you like, and we saw this even during the talk of, when tariffs and trade wars and the like, just the resilience of the global economy in the face of shocks. And there's a lesson in that. I think, really good businesses, when they confront a shock like, the trade war or the war in Iran, businesses don't just sort of sit there and wait for the crisis to hit. Businesses adapt and evolve and pivot to try and avoid the damage and to try and think about how is this going to affect my business and what should I do to try and mitigate the harm. And we saw that with the trade wars and the tariffs, but we also saw this with Iran, whereas businesses decided, okay, I can't get stuff that I need through the Strait of Hormuz. So where am I going to get oil from? Where am I going to get fertilizer from? Where am I going to get things like helium from? And a combination of businesses finding alternative sources of supply, but also governments stepping up and doing things like releasing oil from strategic reserves, did actually help bring a bit more stability to the market.
Although there's a lot of different assets we invest in, probably the asset that most people talk about or focus on is shares. What's happened with shares over the last 12 months, both internationally as well as Australia? Where's common sense been as part of that, do you think?
I think the surprise is that if you just looked at the performance of share markets in aggregate over the year, you'd say, well, it was a great year and there was nothing to worry about. Well, that's clearly untrue. The returns from share markets, especially international share markets, have been very, very strong. Very solid double-digit returns from share markets across the globe, and that's really turbocharged the returns from superannuation funds in the face of what was a very, very uncertain and volatile global environment, especially obviously geopolitically. There's a few lessons in that. One is that share markets are forward-looking. They tend to look, if they confront a crisis, they look for, well, is it going to come to an end? If you can see an end in sight, then markets have a habit of kind of moving on. We certainly saw that in various aspects of the trade war, but also when the war started in Iran, the speed with which markets turned around, markets took the view that, look, at the end of the day, things are going to settle down and we can move on. But what was also in operation was this ongoing, the rise of artificial intelligence and the massive amount of investment spending in associated with artificial intelligence, particularly the rollout of things like data centres and also increasing the capacity of the world to produce electricity to drive those data centres. So that was also a key driver of market sentiment, but also a key driver of economic growth. By some estimates, the spending on artificial intelligence accounted for maybe half United States economic growth over the last year and a half or so. So that's been a big theme in markets. So you've seen a lot of technology stocks in particular have a really good run on the back of that rise of artificial intelligence. Australian equities have tended to lag.
And is it because they don't have that exposure?
It's
is
more
it because of
it's
where
part
we're
of
concentrated?
Yeah, it's part of it is that, we do have technology stocks, but we clearly don't have the right technology stocks listed here in Australia. But what also was the case was that we had a number of big names, if you like, a number of big high-profile Australian companies that didn't really deliver and actually saw quite sharp falls in their share price. And that also tended to drag the Australian share market down. The Australian share market still delivered a reasonably solid single-digit return over the year to June, but it certainly wasn't anywhere near as spectacular as those international markets. If you needed to point to a star, I think you've got phenomenal returns out of a market like Korea, for example, which did extraordinarily strong returns over the year. Again, a large part of that was on the back of artificial intelligence, semiconductors, technology more generally, and Korea is a real star in that sector.
So, Brian, we talk a lot about market volatility, and a lot of the volatility we've seen is around emerging areas, including both SpaceX and also the rise of AI. Your thoughts?
Look, the rise of AI, it's been a key driver of share market performance over the past year. It's also been a major contributor to economic growth, given the amount of investment spending that's happening that's related to the emergence of AI. And I think that does continue. On the other hand, SpaceX, certainly there was a lot of hype around that IPO. And certainly we did see, some pretty stellar numbers thrown about, but the share price has actually fallen really, really sharply. I think there's a lesson in that. And the lesson is one of diversification. Don't get too excited by the hype around any particular sector or industry, and particularly not any particular stock. Even something like SpaceX, which everyone looks at and says, this is so exciting, but we still don't know exactly how SpaceX is going to make money over the longer term, because at the moment it doesn't make any money.
So before we look at the longer term, which especially from a superannuation sense is where we like to focus, can I just ask, if you went back 12 months ago or even 6 months ago, would you have thought we'd be where we are now when we were talking to members that were concerned about really having losses? We had members very concerned about volatility. Did you see it maybe getting to this point where we've got a year where it is rather strong returns that we're talking to members about?
Look, I've long given up on the idea of trying to forecast short-term returns, to be very frank with you. And certainly the speed of the turnaround in equity markets did take me and a range of people by surprise. I think that's fair to say. The fact that we still have ended up with a very solid return it's a great result for members, all things considered, especially given the volatility we've seen this year. And in fact, to be honest, even when share markets fell sharply, you know, if I were to tell you before that event, you know what, this weekend war is going to break out with Iran and the oil market is going to seize up as a result, to be honest, I think you should have expected a much worse performance from share markets, because that was certainly a geopolitical scenario that everyone was worried about for some time. Well, it came to pass, and yet markets managed to turn around remarkably quickly. You know, markets tend to be forward-looking, and certainly this time round, they saw signs that, look, if this keeps on going on for too long, both sides are going to suffer huge losses, that the cost of this is quite horrendous, so consequently, both sides are going to look for an exit ramp, and that's exactly what's happened.
Well, let's take a longer term view. It's not a good opportunity just for us to look back over the last 12 months. It's also a good opportunity to look over the last decade. What are the key themes or key things that have stood out to you when you look back over the last 10 years?
Yeah, if I was starting an investment journey 10 years ago, and this is something a little case study we've run with members when we've been on the road, is that, you know, pretend you were starting your investment journey, you did something remarkable, you picked up a product disclosure statement, and then you did something even more remarkable, you read it.
Yeah, be a very rare person.
You'd be a very rare person, but a wise person. And if you looked at the real return objective that we put into that paperwork, that is our best estimate of what sort of returns are realistic and achievable and sustainable over the coming decade. And we couch it in real terms. So what's the return after inflation, after fees and after tax? So it's pretty much what ends up in a member's pocket, in a member's balance. The returns that have actually been delivered over the 10 years following that day have been much stronger than that real return objective. That the last decade, even though there's been plenty of things to worry about, we had a pandemic, for heaven's sake. We've had conflict in the Middle East. There's been a range of different crises we could worry about over that decade.
It's incredible to think about what's happening.
Exactly.
Actually, yeah.
And yet, despite all of that, the returns from superannuation have actually been very, very strong. And in particular, the returns from share markets have been very strong. It's been a decade where a rising tide has lifted all boats. There was a lot of money around. Interest rates were generally low. There was plenty of money chasing assets, and asset prices performed very, very well. So the real return objective, I think most super funds really shot that out of the water. Looking forward, though, we think the picture looks more complicated. We can't manage money. We can't design portfolios assuming that we're going to get a decade like the last one. We think that it'd be prudent to assume that it's going to be more challenging. But certainly the last decade has been, despite all of that, despite all the things we worry about, despite all the things that have appeared on the news and that we've experienced, the returns have been very, very strong.
So if we think about those returns over the last 10 years, for our high growth option, we've had 10.07% over that period. Have there been key things, and you've already talked about shares as being such a driver over the last decade, but have there been other things that you think as a superannuation investor that have really helped underpin that performance over the last 10 years?
I think in an absolute return sense, it's been very much share markets. International share markets in particular have been very, very powerful drivers of returns. Over the decade, you've also seen quite decent returns from things like infrastructure and private equity. Infrastructure assets in particular have done very, very well. There's been quite big demand for infrastructure assets around the world. At ART, we have long invested in that sector. So we're talking about things like airports and electricity generation and toll roads and the like, and more recently things like data centres. These are assets that they do have their setbacks from time to time, such as airports during COVID, for example. But over time, these sort of private assets do deliver you very good, strong returns, good income growth, and a nice premium above public markets. It doesn't always happen. So, for example, in the last year, private assets have tended to lag the very strong performance from public markets, from share markets in particular. But over the decade, having a solid allocation to unlisted assets, to private assets, has delivered quite often a return premium, but also to help smooth the ride for members over that period, because it means that members don't become as exposed to the volatility that you see in share markets in particular. So it's been very strong from share markets, good contribution from a range of private assets, but certainly it's been a bit of a wild old ride along the way.
So over the last year, we returned for the high growth option, 9.21%, but we do focus and talk a lot about the long term. I know this is really obvious perhaps to many, but why is it that certainly from a superannuation and even a retirement sense that we really do talk about the importance of that longer term focus that members should have?
Yeah, at the end of the day, superannuation is the longest term asset that any of us are ever going to have. And before someone says, well, what about my house? It's like, well, you consume the service it provides you. You can't eat the walls. It's really not an investment. You're consuming its service, shelter. Investment property, that's another matter. But super is something that will last you your entire working life and beyond. So it is the longest term asset any of us are ever going to have. So consequently, if I'm investing for the longer term, which by definition we are, what happens in the next month, the next 6 months or the next year is kind of a bit random. We can't forecast it. We can't design portfolios based on, my ability or anybody's ability. I work with about 150, 160 very smart people in the investment team here. We don't pretend to be able to forecast what's going to happen in the economy or markets in the next 6 to 12 months. We just don't believe that's a reliable way to make money. What we can do, though, is build portfolios that are designed to achieve what's on the box. If we tell our members we're aiming to deliver returns of 3.5% or 4% above inflation after fees and after tax, we need to construct portfolios, and that's over a 10-year period. We need to construct portfolios that are going to maximise our members' chances of getting that objective and preferably beating it without taking excessive risk. That's our focus as an investment team.
It's also a focus, though, you talked about the ability for us to try and smooth markets. Is that also a focus, or do you see that as by virtue of the other investments we have in unlisted and things, or is that actually something that we want members to experience the strong returns, but we do want to give them some comfort in periods of volatility?
Yes, we do. And I think when you see periods of volatility, one thing we do is we try and take advantage of it. So if we see share markets falling very, very sharply, all other things being equal, that means there's opportunity. There's an opportunity to buy quality assets at a beaten down price. And because we're a long-term investor, we have time on our side. We can wait for the inevitable recovery in those assets. And make no mistake, the recovery is inevitable. The timing is uncertain, but the recovery itself is inevitable.
While I've got you here, though, Brian, it'd be remiss of me not to ask you, although you don't have a crystal ball, what is it that's probably on your mind or that you think for members they should be attuned to, if not in the next few months, certainly in the year ahead? And I know especially in times like now, that's probably a very difficult question. But are there some things that you are conscious of and that you are paying attention to?
Look, I often say that it's the job of our investment team, it's our job to worry about things. We get paid to worry about stuff, and ideally we get paid to worry about stuff so that our members don't need to worry, or at least not worry as much. We can't stop people from worrying, but we can certainly encourage them to try and not worry so much and to focus on the longer term. And even though there is a list of things that are on the horizon, things like US midterm elections, ongoing negotiations with Iran is to see whether you get some sort of a settlement there, the ongoing conflict in Ukraine, and there's a whole range of uncertainties out there that we can worry about. But our ongoing challenge, I think, is as a superannuation fund, and the ongoing challenge for you and your team, Josh, is to encourage members to focus on the longer term, to think about super as the longest term asset they're ever going to have, and to invest in such a way that they meet their long-term goals, that they actually have the kind of retirement that they want to enjoy, focus on that rather than what might happen in the next month or next 6 months, because that's inherently unpredictable and unknowable.
And even earlier this year, we spent months on the road together where we were talking to people well into retirement and still even talking to them about having decades of investment potential.
I think that's the interesting thing is that people, you retire somewhere between 60 and 70 typically. Ideally, you're going to be investing for the next 20, 25, 30 years potentially. And so even at that stage, while you certainly will want to protect what you've accumulated, or at least be a bit more focused on protecting what you've accumulated, you also want to make it last for as long as possible. And so this idea that I'm going to hit retirement and just shut down risk and just put the whole thing in the bank or put the whole thing in the cash option, I'm not sure that really works for most people. Now, again, everybody's different. Maybe it does work for some people, but also being aware that even when you hit retirement, you are still going to be a long-term investor.
So for anyone who's listening who is perhaps thinking, right, we got through the last 12 months, they were on the edge of their seat for part of it, who might have found from the last 12 months that it did raise concerns, or the volatility or the movement that was happening, regardless of where we've ended up. For someone who maybe found that a period of concern and worry and exhausting, would you suggest that a starting point is we've got a great tool on our website that allows people to look at their investment profile and just think about where they're invested and where they should be invested? Is that where someone should start, and then informing themselves about our investment options? Or
I think so. I absolutely encourage members to take advantage of those tools, because a big part of any kind of investment journey, in my view, is working out what kind of investor you are. What do you need your money to do for you? What do you want to do when you retire? And how much money will you need, and how much risk will you need to take in order to get the kind of return you need so that you can do what you want? But that's only one part of the equation. If you do the calculations and it comes out that, I'll need to invest in this particular portfolio or this particular option that's actually quite high risk, and if you look at the return profile of that and say, actually, hang on, if I had to invest all my money in that, I wouldn't sleep at night every now and again, because, and you've heard me say this before, Josh, that, sleeping at night can never be overrated. That if you're doing something with money, and it's not just your super, it could be your mortgage, your credit card, personal loan, whatever. If you're doing something with money which is causing you to lose more than about 3 minutes of sleep at night, it's kind of like your body telling you something. Your body is telling you you're taking too much risk. Maybe you need to wind it back a bit. But it's about really understanding those trade-offs. I want this kind of return, but I'm not prepared to take that level of risk, so something's got to give. And the tools are a good starting point. They certainly can lead you on to having other conversations.
So, Brian, I was watching you sleep very, very quietly and well on the flight up this morning.
Well,
that makes me sound like
it was a very early plane.
It was an early plane, but would you say, based on that you're probably more optimistic about where things are than pessimistic about where they've been?
I would say that certainly the global economy has shown a remarkable amount of resilience over the last year to a year and a half, with obviously war in Iran more recently, but before that, trade wars, tariffs and the rest of it, and the ongoing conflict in Ukraine. Certainly there's been a whole litany of things to worry about, but yet the global economy has proven very resilient, but so have share markets. There is an old adage that share markets climb a wall of worry, and they certainly have been climbing that wall of worry over the past year. I think over the next 12 to 18 months or so, I don't think there's any obvious reason to forecast a major economic downturn or anything like that, but it is still a very, very uncertain environment, and it is going to be a challenging environment. There's always going to be things to worry about, but it's our job as investors to stay focused on the longer term, because at the end of the day, we are investing long-term money for our members' retirement, and that's what we spend most of our time focusing on.
Thank you, Brian. Wonderful insights and wonderful conversation as always. Thank you for being here.
Thanks, Josh.
So please do join us for our next episode where Anne Fuchs will be in conversation with our Chief Investment Officer, Ian Patrick, and other experts from our investments team to talk about the performance of the fund over the last 12 months, as well as key assets that we've invested in. On that note, please have a wonderful new financial year. We hope it is a happy and healthy one for you, and we'll see you soon.